Traders, Cousin Vinny coming to you from theclosingprint.com this January 31st, 2021. In this edition of your weekend video newsletter, we'll discuss the indices, all of which moved lower last week as forced selling and margin calls hit several major hedge funds, as I'm sure you're all aware. We also saw the FANG stocks and growth resuming their downtrend and weakness, while bonds and the safety trade in gold have yet to show major concern by institutions. Sectors are fairly weak, with real estate and some buying in defensive sectors showing some interest. Transports, materials, energy, financials, and industrials backed off quite a bit, setting up some opportunities. That said, we're starting off the week with 8 bearish indicators, 8 neutral indicators, and 4 bullish, with a heightened risk if we lose the 3,700 level on the S&P 500 that we could head towards 3,600, where there's been a large accumulation of puts building over the last couple of weeks, as you would be aware of if you've been following the Gamma channel in the main trading room on a daily basis. Therefore, we'll wait on Monday morning, look for institutions to give us direction, and trade only when we can confirm our signals. If you're trading on the short side, there will most likely be some opportunities for taking some nice profits. And if you're thinking on the bullish or long side, there's probably going to be some opportunities this week. To repeat, it's probably wise to be patient and better to sit and wait for us to confirm what institutions seem to have in mind going into this first week of February. Spiders and the S&P 500 closed 3.3% lower last week, with a resumption of the current downtrend as a possibility. 5% would bring us back to that 366 level as a potential trade. We also have the possibility of a bounce on Monday, as we covered in the Gamma channel on the main trading room, further reinforced by a Renko chart which printed its first red brick last week, which tells us to consider a downtrend more possible and probable, while still remaining in a longer-term uptrend. It's this longer-term uptrend that I like to talk about, as you can see in this long-term monthly S&P 500 chart going back to the mid-1980s, where I started trading in 1987. There were many occasions over the years to be concerned or worried, yet the markets managed to gain substantially during these secular bull markets. The last secular bull market was 1987 through 2000, the dot-com bust. We went through a number of years of range-bound action, broke out after starting a bullish trend in March of 2009, continue along a similar path that we've seen in the past. As we can see in this S&P 500 yearly chart, the period leading up to World War II, the period thereafter when the baby boomers were growing up, and the 16-year period from the breakout in the 80s to the highs in 2000, a similar consolidation period as we just pointed out on the monthly time frame, and a current breakout that's only been 9 years in the making. Note that the previous 2 secular bull markets lasted more than 16 years on average. During all of those periods back into the 1940s in through the years in the 80s, 2000, generations went through life cycles that I've presented in the past, and those are reflected in multiple expansion, PE ratios expanding and contracting over our life cycles, the baby boomers, 6 to 8 periods of expansion and contraction if you're still trading from the early 80s or investing. So it's important that we filter out the news and the noise in the markets and look to the two key drivers to the long-term direction of the stock market, that being earnings growth and monetary policy. I think it's safe to say most people are pessimistic, and it shows every time you look at an article or a headline, or if you focus too hard on the news last week with GameStop and AMC threatening some big hedge funds, totaling something like $20 billion worth of losses, and how that can affect the markets in the short term, which can lead to a train wreck. But here's the good news. The Fed believes in its last statement that it believes growth could slow. And if you think about it and understand what that means in terms of future Fed policy, they'll do whatever is necessary to support future growth. That means interest rates, which are already near historical lows, and will for the foreseeable future. And if you've been investing for the last 10 years, it's like the only time I've ever seen this in my lifetime, which, as you have seen, is extremely and incredibly bullish for U.S. equities. We're a debt-driven society, and borrowing costs have never been cheaper. We're also in line for government spending. We also saw Janet Yellen, former Fed Secretary, talking about increased stimulus and a potential infrastructure package. Say what you will about Trump, but that's exactly what he said when he took office. Infrastructure. Together with a dovish Fed, willing to do almost anything to reinflate the economy, meaning future earnings growth of U.S. companies. Now, you'll probably say, yeah, but PE ratios are high. They did spike recently after a nice bullish run for the millennials, which are starting their life cycle, coming out of college, getting married, buying houses, having kids, buying cars, buying new stuff, which affect and have an impact on earnings forecasts, which will have an impact on those high PE ratios. Together with the historically low interest rate environment, there are few investing alternatives to equities right now, as you can see with bonds, which we'll cover in a few minutes. Here's a quick snapshot from Tom Bowley over at stockcharts.com. The earnings summary for the past 2 weeks, with 186 companies on the S&P 500 reporting a beat and 40 missing, with an average beat of 22%. This is from companies with an average market cap greater than $5 billion. While it's also worth noting that the misses include companies that simply matched expectations. So the bottom line is, companies aren't just skating by with estimates, as everyone was anticipating there would be a collapse in earnings. The opposite is the case. They're blowing them out of the water. And the exclamation point is, we haven't seen the pent-up demand yet that's about to be unleashed around the globe when this pandemic is behind us. Growth will be explosive, and future earnings forecasts will be raised, all while the Fed sits on its hands and interest rates remain relatively low. You've already seen what happened if you've been investing from 2009 into the current time period. And you also might want to consider that Q4 GDP's initial reading came in at 4%. And we still have restrictions in place across the country, across the globe for that matter, right? We haven't seen annual GDP above 4% in any year in this century. With that kind of economic expansion coupled with an accommodating Fed, this is going to be a period where we're going to see accelerating earnings across the board. So you can go ahead and short this market in the short term. You'll probably do well. I'll pass. Longer term, markets are set up to move higher. Okay, so that was the bullish case. I want to cover the bearish side as well. In the short term, we're seeing the advanced decline in the red zone. Periods in the past where that's been the case, we saw lower highs and lower lows. That appears to be what we're headed for presently, unless we reverse markedly. We also saw the number of new highs versus new lows fade. As we saw back in February when this crossed below the zero line, that led to more downside. With 4 red elder sticks on the New York Stock Exchange, similar to what we had back in February, except for the gap down on that Monday, February 24th, once the COVID crisis really impacted the markets. That forced selling by institutions and market makers and dealers saw an acceleration of downside action when gamma went negative, which we're flirting with this week, which has an impact on the stocks that are showing bullish breakouts on their point and figure charts, or i.e. the bullish percent index, that continues to drop. The flip side, of course, is that we're not overbought as this is pulling back, so we're waiting for a bounce or an opportunity, as these indicators and oscillators give us a heads up on when to look for a bounce. We're starting to approach the minus 30 level on the mid caps, small caps, and NASDAQ, as well as the S&P in the top panel. Having tested the 50-day last week, if we should drop below the minus 30% like we did back in March, we're still very close to all-time highs, only off a bit more than 4% from the all-time highs. So we're looking for this to get oversold very quickly, lending for a bounce as we've seen in the past, with VIX remaining bearish as a signal going into Monday, which tells us to look for lower lows and lower highs unless volatility collapses to start Monday and Tuesday. If that happens, the ratio between the front month VIX versus the 3-month volatility index near the green zone, we could spike. That would set up a bounce in the markets, as you've seen in the past. Whenever this has happened, shortly thereafter, the markets have taken off to the upside. So there's still potential for a bearish spike leading to a bullish opportunity. While breadth in the short term, of course, continues to unravel, we also see the NIMO McClellan oscillator moving lower. We thought we might see a trough last week. That led to this continuation and more downside. The caveat is whenever we've seen or closed below minus 80 on a daily time frame, that tends to lead to a reversal, a chart of which I pull up every time we hit a minus 80. Over the next 20 days, we can expect to see a 74% probability of a bounce. So while a short-term bearish move is highly likely, the volatility trigger still remains at 3780. We opened below that on Friday. So if we do open below that level and continue lower, there's a heightened probability that we'll see some forced selling in the markets. And what I'll do is add to my hedges UVXY, which got called away on Friday as it traded above 1450, but I did collect premium over the last 6 to 7 periods where we had spikes. I will look for an opportunity to get back in if the need arises. The range in February is still 3750 to 3850, with 3800 as short-term resistance. And a drop below 3700 here on the graph of absolute gamma levels could lead us down to that 3600 node in the short term. One of the neutral indicators, or slightly bullish, is the bond stock ratio. There's really no interest here as yields are near historical lows. The bond stock ratio is at the lows as well. You see the 65 period moving average is rolling over. While we do have a slight bounce, the short end of the curve, the IEF 7-10-year Treasury bond, continues its descending pattern. Lower highs and lower lows got rejected near the 50-day last week, while the 20-year TLT, also similar price action, didn't get all the way back to the 50-day before being rejected. And the 30-year bond, which also shows that descending price action. So it's this relationship between the S&P 500 and the long bond, which we pointed out over the last few weeks. While it won't continue to move straight up from this point, we've had periods in the past where price action in the 30-year bond versus the S&P underperformed. As a result, the S&P continued to rise, but it did have fits and starts at times back in 2009, 11, back in 2015, 16. So we can continue to expect the same type of action, though we are bullish longer term for U.S. equities, as there's really no place to put your money, as we talked about in the bullish segment, with the Fed accommodative and and earnings beats, with low interest rates impacting future earnings growth for the foreseeable future. In addition, high yield corporate debt and junk bonds, a risk on, risk off indicator of sorts as investors search for higher yields. Since the Fed has interest rates so low, they'll go to these instruments when they feel safe in doing so. We did see a little bit of selling last week in both HYG and junk bonds, but they're still near all-time highs. RSI is above 50 on the weekly time frame. All of this happening as the 10-year yield continues its series of higher highs and higher lows, trying to regain the 1.5% that it was trading at back before coronavirus hit. We flagged last week looking for follow through. Momentum continues higher and bullish. Previous occasions where this happened, in the European debt crisis when Greece was a problem, and the Asian commodity crisis back in 2016 led to appreciation in the markets. While we can pull back in the short term as previously discussed, longer term the markets are bullish, thanks to the Fed, low interest rates, and the potential for earnings growth once the pent-up demand hits the markets on a global basis. That said, the US dollar has been strengthening as far as a safety trade is concerned, continues to move higher. It's at the 50-day moving average. This is putting pressure on international ETFs. If for some reason RSI decides to turn back down along with price, that would be bullish for international ETFs, so watch that for an opportunity in emerging markets and other countries, especially in Europe, that have been impacted by the rising dollar of late. Short term, the rising dollar has had an impact on commodities. Copper, of course, in a sideways range similar to what we saw back in the summer of 2020, consolidating for 12 weeks before pushing higher. We're seeing the same scenario at present, watching the US dollar at 50-day resistance. If that should back off, we could see copper moving higher and vice versa if the dollar moves instead. The rising dollar also having an impact on gold prices. As the dollar moves higher, it takes fewer dollars to buy the same ounce of gold. So gold is still in this descending pattern, while crude oil, with a bullish correlation to U.S. equities, continues its sideways pattern for the last 4 weeks. If the dollar does move lower and crude breaks out of this pattern, starts heading higher, that would be bullish for equities. As global economic expansion gets in sync with the U.S., there's a possibility once the COVID crisis is behind us, this bullish scenario that we've been looking for in the commodity index breaks out over the next several months, could forecast and lead to economic expansion as a result, and something that you need to keep in mind. The consumer discretionary versus consumer staples ratio continues higher. This is showing fund managers are bullish the markets, institutions are also bullish as this rises versus falling like in 2018 and 2020 as a reflection of the big picture. That said, short term markets are pulling back, some forced selling and margin calls on those big hedge funds impacting a lot of stocks, with some of the weaker sectors, financials, energy, industrials. So we're looking for a bounce. The strength remains in real estate and some utilities and defensive healthcare stocks. Many of the stocks on the IBD 50 are okay to good in terms of setups. We also saw some stocks that funds are buying that look good. Nautilus is pretty interesting. I'll put an asterisk next to that one. Stocks that are seeing rising profit estimates in green, those in yellow showing relative strength near highs. Note YALA. Also stocks on the blue dot scan that look good. Dow Industrials also look good. These names you might want to check out. Disney looks particularly interesting. And stocks that are on scans that have potential. 300 Finance, QFin, looks pretty interesting. Held the 9 and 21 day last week, showed relative strength. A little bit of selling on Friday. RSI is showing muscle, MACD above its signal line, stochastics turning back up. Chegg also showing some relative strength, purveyor of online and printed materials for grade school through college students. Seeing some activity, volume showing up on Thursday and Friday. RSI still above 50. And one of the things I'm focused on this week, did we see a lot of red volume last week or did we see a lot of bullish volume last week? You can see that with Darden Homes above the 9, 21, and 50 day, RSI above 50. Look at the volume. That's institutions picking up shares going into earnings. With D.R. Horton beating earnings last week, $2.14 per share on revenue of $5.9 billion versus an estimate consensus of $1.72 and $5.6 billion. Again, as mentioned, the average beat for those 186 S&P 500 companies that have reported averaged 22%. This is a good sign going forward with low interest rates and an accommodative Fed, along with no place else to put your money except equities. So it's a matter of following the money and identifying the rotation for potential swing candidates like home builders. Digital Turbines remains in a bullish trend. The one thing I was focused on here was volume. This is what I'm talking about here. I want to see more bullish volume like we had back here in December to indicate that short term we could see a bounce. I think it's more likely we're going to pull back a little bit more on Digital Turbine. That's been a winner for the last few months, while stocks like Etsy also bullish in its trend, but showing some profit taking or forced selling, as we saw some margin calls last week. Watching for Etsy to hold the 21 day. Maybe the volume picks up again. Whole Logic, HOLX, watching for potential follow through. Note the volume on Thursday and Friday. Another company that beat last week as well, reporting earnings of $2.86 per share versus revenue of $1.6 billion, compared to $2.14 estimated and revenue of $1.3 billion. So institutions apparently like HOLX as well. Logitech showing relative strength last week. I'd like to see more bullish volume. Marvell showing the 21 day as support. Volume did pick up on the bearish side though, so we're watching Marvell. Palo Alto Networks security stocks also seeing some activity last week. Looking for a bounce off the 50 day that continues to push above the 9 and 21 day. Volume's a little bit more bearish than I'd like to see, obviously, so we'll keep an eye on this one, as it could be printing a lower high and a lower low. If it loses the 50 day, could see a quick move back down to some of these previous support levels. Perkin-Elmer from previous watch lists has been pulling back for a few weeks now, holding near the 50 day. Decent probability that this one can continue. Watch it for a break higher above 150 this week and continue through 153.70. Maybe a chance to get back to 162 in the short term. As RSI suggests, and MACD as a function of price starts to turn, watch for volume to pick up. Stochastics oversold, which is what I want to see for any move higher. Repligen also bouncing here, RGEN. Volume picking up on Thursday and Friday. Potential follow through if it closes above the 9 and 21 day. Continue to add to that one. ServiceNow. Buyers stepped up at the pullback to the 50 day. Looking for a breakout of this range. Volume is a little suspect though, so I'll watch this one for the next week or so for a breakout of this range or a rejection and resumption. Skyworks, big gap up on earnings. Lots of volume. One of those companies has a big beat last week as well. Earnings $3.36 per share on revenue of $1.5 billion versus an estimate of $2.08. Huge beat there on $1.1 billion in revenue as an estimate. I would just wait for a little flag or consolidation for a better entry, as institutions looks like they fell all over themselves buying shares last week on Friday. Thermo Fisher showing what I'd like to see on many of the stocks we've covered thus far. Volume increasing, a move back, and a close above the 9 and 21 day RSI above 50. Looking for a follow through and a move above this area of resistance. Volume by price on the left histogram. If we can get through this level, looks like we've got higher lows. Looking for a higher high and a test of the breakout or 52-week highs. Trex, building supply, alternative to wood for decking. Nice bounce at the 21 day. They report soon, I think. Looking at the volume here and the potential for a bounce. Stochastics trying to turn. Watching a lot of these building supply companies after they report earnings as a potential guide for the industry group in the short term and intermediate term. Virtu Financial looking for a follow through here as well. Nice volume last week. Company reporting February 9th. West Pharmaceuticals looking for a follow through. Bouncing off the 9 and 21 day with volume way above average on Friday. It also reports February the 11th. Last time around they beat and raised their guidance. So it's possible this does break higher. Look at the wicks here. Need to get through those levels for follow through. In addition to the IBD 50, stocks that funds are buying has our interest as well. Want to keep an eye on this list. AHCO in a defensive sector, waiting for it to break higher at some point. Looking for stochastics to continue higher as well. Again, this is a stock that funds have been buying lately. Just looking for a push off the 9 and 21 day, a breakout above these levels and 52-week highs. Another stock funds are buying, Fuel Cell Energy, continues along this bullish trend, as well as Fulgent Genetics. Many of you have traded this one or are swinging it in the short term, breaking out above this level in the 50s, leading to this current break and doubling in stock price. Volume showing institutions have been picking up shares. Looking for a little flag or a pullback for an entry or an area to add as the company continues to show relative strength. Grow generation, a lot of talk about cannabis stocks last week. Looking for a follow through. A lot of Motley Fool articles this weekend concerning cannabis, along with comments from Chuck Schumer in the Senate about passing a bill to legalize pot on the federal level. In SEGO, as a potential bounce, we're looking for some buyers to step up around the 9 or 21 day. 5G industry group, Nautilus Group. If you've paid attention, if you've been in a Best Buy lately and you happen to walk around the store, you'd notice that they have a Nautilus treadmill in most of the Best Buy stores and other exercise equipment. That's a direct competition to Peloton, a very large discount to the Peloton price. Nice cup pattern. This is probably one of my favorite setups this week. Volume showing institutions have been picking up shares. Relatively inexpensive name. I think it's destined for a breakout after this cup completes and a handle. Perhaps, maybe it continues higher. Depth of the pattern, about 10 points, so 38 would be the ultimate price, with about a 20% move if you add about $5 on top of this as a potential short-term target. Again, these being from the list that Investors Business Daily publishes of stocks that funds are buying. Looking for Tibio to do something again. After the dip to the 50-day got bought, 21-day continues to hold. Volume picked up on Friday. Additional list from Investors Business Daily, stocks that are showing relative strength at highs when the markets are pulling back. That's a significant and important criteria to watch. Buckle, BKE, following through. With a little selling on Friday, I would look for a potential pullback to the 90 EMA that gets bought. Volume picks up again, showing institutions are still interested. Canopy growth in the news last week, following through off the 9 and 21 day. Nice volume. Tuesday, Wednesday, Thursday. Friday was a little bit of profit taking, it looks like, or sell the news. Discovery Channel, cable, content provider, in a nice bullish trend. Volume was pretty interesting on Thursday and Friday. Potential for a follow through. X1, this one looks good too. following through for the last several weeks. Volume showing institutions have been picking up shares. This qualifies as a high tight flag. Now we just look for the flag. You can put a buy stop above the flag. That's probably going to take about a week or so for some consolidation at these levels of the current gains, but looking for a breakout in the short term of X1. The Lovesac Company, kind of humorous name, I'm not sure what they do, but they're consolidating along a bullish trend, showing relative strength as the markets pull back. Ormat Technologies consolidating the recent gains above the 9 and 21 day. Volume showing institutions have been picking up shares. The Alto Group looking for a follow through here as well. Volume last week, pretty obvious. Looking for a follow through and a breakout. Additional silver stocks that are seeing action. AGQ, ProShares Ultra Silver, bullish trend. Look at the volume on Thursday and Friday. Social Capital, the SPAC that Shamath is running, IPOE, creating a lot of buzz last week. PCY, Invesco Emerging Markets Sovereign Debt ETF, looking interesting and bullish, volume picking up. Remember what happens if the dollar continues and gets rejection at the 50-day. Could affect a lot of these international bonds and equities. ETFs, Aberdeen Standard Physical Silver Shares ETF. This is one I wrote a blog post about last week. Looking for a follow through. If the Reddit crew has their way and shorts cover on silver. Same goes for the iShares Silver Trust. Looking for a follow through here. Volume increasing on Thursday and Friday. And Vanguard Mortgage-Backed Securities ETF. That one's showing some follow through as well. As real estate improves, this could break out and move higher. Watch MACD crossing, volume showing institutions picking up shares, and stochastics is rising. Okay, traders, that's going to do it for me. This is Cousin Vinny coming to you from theclosingprint.com, the 31st of January, with your weekend video newsletter. I'll send out a watch list later tonight, around 11:30, 12 o'clock on the East Coast, 8:30, 9 o'clock on the West Coast. Be sure to check your inbox for that. You can always check the watch list channel in Slack as well as the alerts channel for the weekend video and for the watch list if you don't feel like checking your email. Take care, everyone. I hope this helps. I'm feeling a little bit better. Thanks for the well wishes. I'll talk to you soon. Ciao.